Okay, I think we'll go ahead and get started. Welcome everybody to the Secure Act 2.0 webinar. This is part one of part two of two parts, presented by Union Bank and Trust. My name is Jason. I manage the education department here in Retirement Plan Services at UBT. Presenting today is going to be John Nouns. John is a vice president and, as most of you know, an ERISA attorney, as well as a relationship manager here in Retirement Plan Services at UBT. So just a little bit of housekeeping here. We will leave some time at the end for questions. If you do have any questions, please hang on to those until the end. And if you utilize the chat box, we will certainly get to those questions as well. And John's contact information will be at the end as well. So if you have questions after the fact, certainly reach out to John as well. This is being recorded and it will be included in the quarterly plan sponsor email, as well as posted to the website as soon as it becomes available. And please remember, if you haven't done so already, register for part two in this series. It'll be next Wednesday, same time, March 29th at 10 a.m. Central Time. And then before I hand it over to John, want to get through, this will let me. I'm not going to read this verbatim, but we do want you to know that this is just strictly for informational purposes only. Again, I'm not going to read this disclaimer verbatim at all, but basically what we're saying is John's not going to provide any legal, tax, or financial advice. This information is strictly meant for your informational purposes only. And so that's all this particular disclaimer is saying. So with that being said, I'm going to hand it right over to John.
Thank you, Jason, and welcome to part one of Union Bank's webinar on Secure 2.0 Act of 2022. Again, reiterate what Jason said. Part two is going to be next Wednesday, March 29th at 10 a.m. It is not going to be a repeat of the material we're going to be talking about today. It's going to be all new material. And as Jason said, let's do questions at the end. I hope to leave a couple of minutes, but you can always contact me through phone or email at any time after the presentation, and my contact information is on the last slide. And then finally, I always appreciate Jason's hosting duties and technical help in putting these things on. So that said, let's get into it. So Secure 2.0 Act of 2022 is a massive retirement bill that was tucked into an even more massive spending bill, the Consolidated Appropriations Act of 2023. So Secure was passed on December 29th of 2020. It was actually enacted December 29th of 2022, not 23, as we see on the slide here. And there's 90 plus retirement related provisions in there. And between this week and next week, we're only going to be talking about those provisions that we think most employers will be most interested in. So Secure 2.0 is named because it builds on the initial Secure Act that was passed in late December 2019, again, as part of a massive spending bill. So as we go through this week and next week, I want to kind of point out at the top of the program some trends that have been going on in the retirement area. First of all, we'll see, especially with Secure 2.0 here, that there's a lot of optional provisions rather than mandatory provisions. So a lot of times when you have retirement plan legislation, it's a lot of thou shalt do this, thou shalt do that. Well, this is thou may do this and thou may do that. And so you'll see that here. The other trend that's been happening, and again, Secure 2.0 really keeps that trend going, is that there's many more opportunities for participants to receive distributions from the plan. So it seemed, at least in my mind, not too long ago, about the only time you could get money out of the plan is if you terminated employment, or some plans allow for hardships while you're in service, and some plans allow for in-service distributions at age 59 and a half. But we will see here this week and next week that there's many more opportunities for participants to get distributions from the plan. And I think what the logic is, or is the concern, is that Congress is worried that not enough people are participating in retirement plans because they're concerned that these young folks are going to put money in the retirement plan and not be able to get their money out for 20, 30, 40 years or so. And so Congress has been making it easier to get money out of the plan before retirement. And then finally, this trend of Rothification. And what we mean by this is that we can see over the last several years, and retirement plan legislation, is that Congress is inserting more Roth provisions in retirement plans. And the reason for that is that the federal government wants tax revenue now. If everything's done on a pre-tax basis and I'm 25, I put money into my retirement plan, I'm not going to take it out till I'm 65 or even later than that. The government has to wait 40 plus years to get their revenue out of those dollars. And so what Roth features do is allow money to flow to the government immediately. And so when you think about it, there was the Roth IRA, then the Roth 401k got introduced, and then later Congress said, hey, we can now make internal Roth conversions, take our pre-tax accounts and convert them to Roth accounts in the same plan. And we're going to see this week and next, there's some more Roth provisions that are being introduced to retirement plans. So keep your eye on these trends as we go through the materials this week and next week. The first one, and by the way, we're going to be presenting these materials based on effective dates. So we're going to be first talking about those provisions that are effective now in 2023. The first is this increase in RMD age. So as a refresher, as we know, that retirement plans are retirement plans and they're not estate planning tools. So the government tells us when we have to start taking money out of our retirement plan. And those are called the required minimum distribution rules. And there's dates set where we have to take dollars out of our plan. It was age 70 and a half for years. The first secure increased that to age 72, and Secure 2.0 increases that to age 73 for some folks, depending on when they were born, and to age 75 for other folks. The language on this screen reflects the statutory language, but it's tough to fight through because you start having to do some math. And so what I've done is provided you a cheat sheet that shows us the various required minimum distribution ages. So if you were born before July 1st, 1949, you have an age 70 and a half RMD age. If you were born on or after 7/1/49 and before 1951, you've got an age 72 RMD age. If you were born 1951 to 58, it's age 73. If you were born 1960 or later, it's age 75. You'll see I've got a question mark for someone born in 1959. And that's because if you do the math with our previous screen, you will see that someone born in 1959 has both an age 73 RMD age and an age 75 RMD age. So obviously that's a drafting error, and there's going to need to be some sort of technical correction before 2032, 2033 timeframe to tell us what about the folks born in 1959. Next, disaster-related distributions, and this is kind of piggybacking on those COVID distributions that were in play a couple of years ago. So as a reminder, this is an optional provision. It's not required. So you don't have to offer this disaster-related distribution to your participants. If you do, however, you can put it into your 401k plan, your 403b plan, and your governmental 457B plans. You can also have these disaster-related distribution provisions applied to your money purchase pension source. So I know we have some employers on here that used to have a money purchase pension plan that was merged into their 401k plan. And there's different distribution rules that apply to that money, that merged money purchase pension account compared to other accounts in the 401k plan. You can allow disaster-related distributions out of that money purchase pension source. So some background here, what has happened up to now is that Congress basically enacted disaster-specific legislation. So if there was a hurricane, Congress would enact hurricane assistance and allow special distributions or increased loan amounts based on specific disasters. Well, what this provision does is we don't have to wait anymore until disaster-specific legislation. What this says is that if a participant lives in a federally declared disaster area and has suffered some sort of loss, economic loss due to the disaster, that person can avail himself or herself of these disaster-related distribution rules if the plan allows for it. Now, this is disaster-related distribution relief. As you know, for those plans that have hardship distributions, a participant can receive a hardship distribution based on federally declared disasters. This is separate. So we know for a hardship, we can get a hardship for purchasing a home, medical expenses, tuition expenses, and that. And we can also get hardship distribution for disaster-related losses. This is different from that in a couple of different ways that we're going to see. So if you had these disaster-related distribution provisions in your plan alongside of hardship distributions, the participant could receive money both from a disaster-related distribution standpoint and from a hardship distribution standpoint. And any time that there's a hardship distribution being made, the participant always has to receive other available distributions before tapping a hardship distribution. And so if this provision is in the plan alongside a hardship distribution provision, there's been a federal disaster, the participant needs to take this disaster-related distribution before receiving a hardship distribution for the same purpose. So one difference between a disaster-related distribution and a hardship distribution for the same disaster is that the hardship distribution, we can get it for whatever our damage is if we've got enough money in the account. But in the disaster-related distribution, it's a limit of $22,000, and that amount is not indexed. Also, for a disaster-related distribution, normal tax rules apply, just like a hardship distribution, but a disaster-related distribution is exempt from the 10% early distribution penalty, whereas a hardship is subject to the 10% early distribution penalty. Like a hardship, we can't roll it over. It needs to be a cash distribution. However, unlike a hardship distribution, a participant can elect to be taxed on that disaster-related distribution over a 3-year period. So for example, I receive a disaster-related distribution in 2025 of $21,000. I can pay taxes on $7,000 of that distribution in 25, pay taxes on another $7,000 in 26, and then make the final payment on that final taxes on $7,000 in 2027. Also, unlike a hardship distribution, I can repay that disaster-related distribution back into the plan within 3 years of when I received that distribution. And to the extent that I've paid taxes on that disaster-related distribution, I can receive a refund of the taxes that I paid. So that was disaster-related distribution provisions. There's also in Secure 2.0 disaster-related loan provisions. Again, optional, not required. So background here for those plans that have loans, as you know, you can only receive a participant loan up to $50,000 or 50% of your account balance. Well, if you live in a disaster area and you've suffered an economic loss and the plan allows for it, a participant can receive a disaster-related loan up to $100,000 or 100% of the participant's account balance. Again, this is similar to especially a couple of years ago for COVID loan provisions. And like those COVID loan provisions, these disaster-related loan provisions allow loan payments during the federal disaster incident period and 180 days past that. Any loan payments that become due during that period can be suspended for a year, which means that the 5-year maximum loan period for this COVID-related, or rather this disaster-related loan can be extended. That 5-year period can be extended to take into account that we're not going to be making loan payments for a certain period of time. Moving on, also effective in 2023 is this concept of self-certification of hardship distribution. So now, and again, optional, not required, but provisions allow in Secure 2.0 for a participant to self-certify that he or she has incurred a hardship distribution event and the amount of that distribution to satisfy that hardship need. So under these provisions, I can walk into HR and say, yep, I've suffered a hardship, give me $100,000. Theoretically, HR or whoever makes these decisions can say, okay, just self-certify here. Now, I think unless HR, the employer, knows has actual contrary to the knowledge, a distribution can't be made. So if I go to HR and say, hey, I know there's self-certification rules here for my hardship distribution. Let me tell you up front, I don't have a hardship. I just need $100,000. The employer can't make a distribution because of that. But other than actual knowledge to the contrary, self-certification can work. We're going to apply these provisions, if you want to 401k, 403b, and governmental 457b plan, which don't have hardship distributions, but have what we call unforeseeable emergency distribution. So that said, we expect that some employers may implement these self-certification rules. However, we do expect the huge majority of employers will continue to require documentary evidence of the hardship distribution reason, as well as the amount needed to satisfy that hardship. Roth employer contributions. This provision was effective on the enactment date of this legislation, which was December 29th of 2022. We have had a couple of phone calls on this because this sounds like a great deal for those folks who really like Roth. But there are some hurdles to putting this into your plan right now. This is optional, it's not required. And what happens here, if you put it into your plan, is you can allow a participant to elect whether to receive the matching contribution or non-elective profit sharing contribution or your safe harbor contributions to be made on a pre-tax basis or a Roth basis. So we've been living with for a while that I can make an election for my 401k deferrals, whether to make that pre-tax or Roth. Well, effective 12/29 of 22, I can elect, if my plan allows for it, matching contributions and non-elective profit sharing contributions or safe harbor contributions to be made to the plan on pre-tax or a Roth rule. So I could, I guess, theoretically, if the plan allows for it, have half of my matching contribution on a pre-tax basis, half of my matching contribution on a Roth basis, make a separate election for my profit sharing contribution, have 40% of my profit sharing go in pre-tax and 60% on a Roth basis. It can get very complicated in a hurry. And as I said, we're not quite ready. And when I say we're not quite ready, I think the entire retirement industry is not quite ready to implement Roth employer Roth contribution provisions right now. So it's a little bit surprising why it wasn't effective in 24, 25, or 26 to let the infrastructure be built to allow this. And all I can think of is this is one of those areas where Congress wanted tax revenue today, and so they allowed this there. But I think it is problematic in a couple of areas. So what's going to happen here? No surprise, if I elect to receive a employer contribution in the form of a Roth contribution, I'm going to pay taxes when it's going to be contributed to the plan. Also, any Roth employer contributions made to the plan must be 100% vested. We're going to need guidance from the IRS what this means that Roth employer contributions are 100% vested. So for example, if I'm 60% vested in my matching contribution account, am I going to be allowed to do this Roth employer contribution at all? Maybe 60% of my profit sharing contribution? Well, we don't know, but presumably the IRS is going to issue guidance that I think that says only a participant who is 100% vested in that Roth employer contribution source will be able to make this election. But again, we're going to need more guidance to confirm that. As I said, this Roth employer provision is effective immediately, but the infrastructure needs to be built before it can happen from practical terms. That means payroll providers and the plan record keeping system and put election procedures in place to make this happen. Also, there's going to be education hurdles, letting participants know that if they make a Roth election, that it's going to result in immediate taxation for those contributions coming in. And I assure you that this is a big education hurdle. My office sits right outside the call center, and every once in a while, a participant will call up and say, hey, I understand, for example, that my plan allows an in-plan Roth conversion. So I would like to take my entire account balance, my pre-tax account balance, and convert it to a Roth account inside the same plan. And what these participants are thinking is they heard somewhere, they read somewhere that at the end of the day, when the money comes out of the Roth account, that it's all going to be distributed tax-free. And that sounds like a great idea. And as you guys know, is that if I leave my Roth dollars in there for at least 5 years, and I've attained, for example, age 59 and a half, and I receive a distribution from my Roth account, indeed, it's all going to be tax-free. The contributions were taxed originally when I put them in, and the earnings are going to be distributed tax-free. And so I think that's what participants hear and have in their mind. But if a participant calls up and says, yep, I've got $50,000 in my account balance, transfer it all over, what they don't realize, and I don't think they hear all the time, is that that's a $50,000 tax bill this year if they make it. And so that, I think, is going to be an education hurdle. Also, we need some sort of guidance on how this is going to be reported. Is it going to be reported on a 1099 or a W-2? We'll need guidance on that. The good news is, though, is that there is a workaround when it comes to this. So if your plan allows for in-plan Roth transfers and rollovers, then you can see what a participant can do. So let's say I'm going to have a $10,000 employer contribution made to me at the end of the year. If I have this Roth employer contribution feature built into the plan, I can say, yep, make it to the plan on a Roth basis. But you don't need that Roth employer contribution feature into the plan. Instead, when that $10,000 hits my account pre-tax, I can turn right around and use the in-plan Roth rollover feature to turn that into a Roth account. And I think what this does, it allows participants to better time and take control of the amounts that are going to be taxable. Because if at the end of the year I say, yep, send that $10,000 profit sharing contribution, put it in a Roth account, well, that person may not have set aside the dollars to pay the taxes on that $10,000 Roth employer contribution, and they may be surprised with a tax bill at the end of the year. Whereas if you take advantage of the Roth, the in-plan Roth feature, they can actually time and consider when they want to take those dollars into tax. For example, at the end of 23, make a transfer, in-plan transfer of $10,000, and then turn around in a couple of weeks and make another transfer and stick that into the 2024 taxable year. So I would suggest, if you are hot on implementing these Roth employer contributions, let's wait a while for the infrastructure to be built. But if you don't already have it into your plan, talk to your relationship manager and put the in-plan Roth rollover feature into your plan. Enhanced small employer plan startup tax credit. I know we've got a couple of employers on the line that are interested in establishing a retirement plan. They don't have one yet in place. And so I wanted to spend a couple of minutes talking about these small employer plan tax credits. So right now, previous law and actually current law says, if I'm a small employer, I can receive a tax credit up to 50% of my plan startup costs, up to a maximum of $5,000 per year. And that's a 3-year tax credit, the startup year and the next 2 years. So small employer means an employer with 100 or fewer employees with at least $5,000 of compensation in the preceding year. So I've started up my brand new qualified plan. Also, it applies to a SEP if I want to start it, or a simple. It's only available if I haven't had a plan in the preceding 3 years that covered substantially the same employees. So that's what we've been living with. But what Secure 2.0 says is increases that 50% of plan startup costs to 100% of plan startup costs for really small employers. And really small employers means 50 or fewer employees with at least $5,000 in compensation. We still have a maximum credit of $5,000. And by the way, the formula is it's the greater of $500 or $250 per non-highly compensated employee. So if I've got 4 non-highly compensated employees in my plan, that's $1,000 tax credit. If I've got 30 employees in my plan, I've got a maximum $5,000 tax credit, same as what's happened, same as pre-Secure 2.0. So the only difference between pre-Secure 2.0 and now is that we get this 100% of plan startup costs if we have 50 or fewer employees. Another really good thing that is just absolutely brand new is this so-called employer contribution tax credit that can be taken on top of that enhanced small employers plan startup tax credit. And so what we've got here is this is based on employer contributions made to employees. So I can receive a tax credit for employer contributions I make to the plan, but I'm capped, a couple of caveats here, I'm capped at $1,000 tax credit for each employee, and I can't take a tax credit for any employer contribution made to an employee who has more than $100,000 in FICA wages. Now, if I'm an employer with 50 or fewer employees, I can take advantage of that full tax credit, that $1,000 max employer contribution for each employee that I make an employer contribution for. So that plan startup tax credit was a 3-year tax credit. This contribution tax credit is a 5-year tax credit. 100% for the first 2 years, 75% in third, 50% in fourth year, and 25% in fifth year. So you can see what Congress wants to do with the startup tax credit being enhanced and this new contribution tax credit being introduced. Congress wants small employers to adopt retirement plans. This contribution tax credit gets phased out if you have between 50 and 100 employees. So more than 100 employees, you can't get a tax credit under these rules. And how that phase out works is, if, for example, if I've got 60 employees, that exceeds 50 employees by 10%, multiply it by 2, that's a 20% reduction in the tax credit. So here's how this works as a practical matter. Let's say I'm an employer with 40 employees. So that means I've got that full credit available to me because I've got less than 50 employees. And let's say I make an employee contribution of $5,000 to an employee. Now, ordinarily, without the cap under this rule, I would be able to get the entire $5,000 tax credit, but I'm capped at $1,000. So alternatively, if I made a employer contribution of $500, well, I could get all of that $500 because I'm capped at that $1,000 limit. So here's what happens for our $5,000 employer contribution. Years 1 and 2, I get the max of $1,000 tax credit. Year 3, I also get that $1,000 tax credit because as a rule, we're going to take 75% multiplied by $5,000. It's a $3,750 employer contribution, but remember, I'm capped at $1,000. We do that same math going down. $5,000 contribution, year 4, 50% credit would be $2,500, but I'm capped at $1,000. Year 5, we do the same thing except for 25%. So let's say if we had a $600 employer contribution and we're at year 4, 50% of that, for that $600 employer contribution, we'd be capped at $300 for year 4. So that's kind of how that math works. Moving on to terminal illness distribution provisions effective 2023. This is odd in that it looks, acts, and feels like a new distributable event, but it is not. And you'll see as we go through this slide, he goes, yeah, it sure feels like it's a new distributable event, but it's not. And the word is that this is a mistake in the legislation. Likely, this is an error. The word is that Congress always intended for this to be a new distributable event, but it is not as we sit here today. We expect it to be an optional distributable event, not required. And when I tell you that it acts, looks, and feels like a new distributable event, well, look at what we've got going here. The normal tax rules apply, but it's not subject to the 10% early distribution penalty. We can repay that distribution within 3 years after, and we can get a refund on any taxes that we paid on that distribution. So it applies to 401k, 403b, and governmental 457b plans. There's no self-certification here. We need to give a note to our plan sponsor that says, we got a physician certifying that the participant has a terminal illness. So how would this work if it is not a new distributable event? So let's say, for example, I'm 50 years old. I terminate employment, and so I can receive a distribution from the plan. And it could also work out if the plan for some reason allowed me to receive an in-service distribution at age 50. I receive a distribution, but not because I'm terminally ill, but because I attained age 50 and the plan allows me to get an in-service distribution at age 50, or I've terminated employment. In any event, I'm using a distributable event that already is in the plan. So I receive that distribution. I hand the plan administrator / sponsor a certification from my physician saying I have a terminal illness. And so in that at that point, the employer would code my 1099-R as a terminal illness distribution. It's not subject to the 10% yearly penalty. But again, word is that this was an error in drafting, and we expect this to be a new distributable event as soon as a technical correction comes out. Matching contributions on student loan payments. We've also had a couple of employers ask about this, so I consider it a big ticket item. I don't know if a whole lot of employers are going to adopt this. I suspect it's going to be of great interest to some employers that want to put this in their plan. And so what the concern here that's being addressed is that if I have a younger workforce, I'm concerned that they can't make 401k contributions to the plan because all of their discretionary income is going to service student loan debt. And so if I can't make any 401k contributions, I'm never going to receive any matching contributions. And so that's what this provision here is expected to, or hoped to alleviate and address the issue that participant is not getting any matching contributions. It's an optional provision, it's not required. And what we're doing here is that the employer is going to make contributions based on a participant's student loan payments. This can be a regular matching contribution, it can be a safe harbor matching contribution. It's allowed in 401k, 403b, governmental 457b, and simple IRA plans. And so what we know is that when I receive a matching contribution, I'm receiving a matching contribution based on my 401k elective deferrals made to the plan. What this provision says is that I can also receive a matching contribution based on my student loan payments. So that there's no confusion here, keep in mind that a matching contribution is a matching contribution is a matching contribution. And what I mean by that is it's not a special matching contribution. It's just that I'm matching a different type of payment. I make 401k contributions to the plan. I receive a matching contribution based on that 401k contribution. Same thing, but different. Now I make student loan payments. I'm not making a 401k contribution. I'm making student loan payments, and I receive a matching contribution on that student loan payment. So same match rate, same eligibility rules, same allocation rules, same vesting rules, and it is a single match source. In other words, we're not going to record keep that by saying this was a match on a 401k deferral. This was a match on a student loan payment. A match is a match as a match. And give you a little bit of refresher, because I know oftentimes employers get mixed up the difference between eligibility rules and allocation conditions. Eligibility rules, I have to satisfy eligibility rules before I even get into the plan. So let's say there's a year of service eligibility rule in place. I satisfy that year of eligibility. I enter the plan, let's say July 1st of 2024. Now, just because I've entered the plan, all that means is I can make 401k deferrals, but I'm not necessarily entitled to any matching contributions for 2024. Maybe the plan says that I have to complete 1,000 hours and be employed on the last day of 2024 to get a match. So I get my 1,000 hours in 2024. I've entered the plan on 7/1 of 24, but I quit on December 30th. And I won't get a matching contribution because even though I satisfied the eligibility rules, I didn't satisfy the allocation rules that apply to getting a match for that year. Of course, if we're talking about a safe harbor match, there are no allocation rules in play, and I would automatically get that. But my point is that sometimes there's confusion between eligibility rules and allocation rules. Remember, a match is a match is a match. The legislation also allows a participant to self-certify an annual basis. Hey, employer, I just made $10,000 in student loan payments. Give me my match. That is good enough. That said, we're expecting that employers will require at least some documentation that I have to show that, yeah, here's the $10,000 in student loan payments I made, and here's the amounts, here's the dates, and here's the lender that I paid these payments to. But you can allow the participant to just self-certify. Yep, I did $10,000, give me my match. Little bit in the weeds for non-discrimination testing purposes. Student loan payments are not going to be included in 401k non-discrimination testing because they're student loan payments. They're not inside the plan. But the match on those student loan payments will be included in the matching contribution non-discrimination testing. We can also run separate 401k non-discrimination testing for participants who make student loan payments compared to those participants who are making elective deferrals to the plan. So what happens if, because remember, the legislation lets the participant to annually certify student loan payments. What if I'm an employer that makes matching contributions on a pay period basis, but my participant's only going to come to me once a year to certify? Well, the IRS is expected to issue regulations on how to deal with, for example, making matching contributions on deferrals on a pay period basis, but making matching contributions on student loan payments on an annual basis. So remember, a match is a match is a match, and this example shows us what we mean. We've got a plan that provides a 50% match on deferrals and student loan payments. Our deferral participant makes $4,000 in 401k deferrals. Our student loan payment participant doesn't make any deferrals to the plan, but instead makes $4,000 of student loan payments. Both participants are going to receive a $2,000 matching contribution. If I'm eligible to receive a match on deferrals, I'm eligible to receive a match on the student loan payments. Same vesting schedule applies. If there's a 4-year vesting schedule on matching contributions for deferral participant, there's going to be a 4-year vesting schedule for the student loan payment participant. Again, optional, not required. Another good change is this, and it's effective next year, is this no lifetime required minimum distributions required from employer-sponsored accounts. So let's take a look what the current law is as of today. If I have a Roth IRA, I don't have to receive any required minimum distributions during my life. RMDs only start after my death, and my beneficiaries are going to have to receive death RMDs from that Roth IRA account. Now, instead of a Roth IRA account, I have a Roth 401k account, or a Roth 403b account, or a Roth governmental 457b account. Well, now I have to receive lifetime RMDs from my Roth account. Whether I'm 70 and a half, 72, 73, or 75, whatever, I need to receive lifetime RMDs. Doesn't make a lot of sense. Congress finally cleaned it up with Secure 2.0 and has put employer-sponsored Roth accounts on the same footing as Roth IRA accounts. So beginning with distribution years in 2024 and beyond, there's no longer going to be a need to receive an RMD from an employer-sponsored Roth account. Now, by the way, there was always a workaround in here, right? I could take my distribution from my Roth 401k account, move that over to a Roth IRA account, but that's no longer going to be necessary. No lifetime RMDs out of a Roth account and employer-sponsored plan. Now, this is effective for 2024. What if my first RMD is required for 2023? As you know, I can receive my first RMD payment, let's say in 2023, I can receive it as late as April 1st of 2024. Well, when I receive that RMD in March of 2024, that's actually my 2023 RMD. I'm just receiving it in the first couple of months of 2024. So that 2023 RMD will still be subject to the lifetime RMD rules. It's only when I receive my 2024 RMD out of my Roth account later on in 2024 that is no longer required to be distributed under the lifetime RMD rules. Next, another distributable event. If I am a victim of domestic abuse and my plan allows it, I can receive a domestic abuse distribution. Again, optional, not required. That first bullet point, I'm not going to read it, but it's very broad definition of what is domestic abuse. You can receive a distribution if the plan allows from it from your 401k, 403b, or governmental 457b plan, but you can't receive a domestic distribution from a money purchase pension account that happens to be in your 401k plan. The distributable amount here is the lesser of $10,000. That'll be adjusted for inflation as we go forward through the years, or 50% of the vested account balance. And you can see a trend here. The normal tax rules will apply to a domestic abuse distribution, but the 10% early distribution penalty will not apply. The distribution can be made for up to 1 year following the abuse. The domestic abuse victim can repay that distribution back to the plan within 3 years and get a refund of any taxes that he or she paid on the domestic abuse distribution. Can't be rolled over. And this is another self-certification rule here. So the participant doesn't have to explain or go into detail or show some sort of proof. The participant can self-certify. I am a domestic abuse victim. I'd like a distribution from the plan. If you're going to put it into your plan, it's available for distributions on or after 1/1/24. So that brings us to, well, I'm sorry, we got one more thing. That's the end of the provisions that we're going to cover this week. I do want to talk about next steps, and I'm going to include this next step slide in our presentation next week. But so what do we do from here? Well, as you know, whenever there's new legislation, we need to amend the plan. Well, we don't need to amend our plans until the last day of the 2025 plan year. 12/31/25 for 401k plans that are calendar year plans. If you have a government plan, it needs to be amended no later than the last day of the 2027 plan year. That these years really line up with the amendment deadlines for the initial Secure Act passed in 2019, as well as the CARES Act provision. Plans that are on our pre-approved document have already been amended for CARES Act, not yet for Secure Act, because frankly, we're still waiting for some guidance on the initial Secure Act that we still hope is coming. Now, even though our plans don't have to be amended formally for a few years, we do have to operate our plans in compliance with the new laws. So you need to tell us if you're going to implement any or all of these provisions. And so what we're going to be sending out soon, and we're going to do this in ways, first for those plans that have adopted our pre-approved document, that's 401k plans, profit sharing plans, and 403b plans, you're going to shortly receive a document from us for you to tell us how you want the plan to be administered between now and 2025. Then we're going to send out a similar document for our government plans and such, and individually designed plans that are not using our pre-approved documents. And we're going to also do this in stages. So later on this year, I expect in the fall, we're going to send another operational compliance document out for the 2024 provisions and beyond. Also, we're going to be holding any client webinars as needed or requested. And I put this in your court if you believe that we should have a webinar on a very specific topic, for example, long-term part-time employee provisions that we're going to talk about next week, I would be glad to do that. And so let me know if you want Union Bank to do a deeper dive on one or more areas relating to Secure 2.0. Next, even though technically it's not required right away or for a few years, in fact, if you're an ERISA plan, you have a requirement, a summary of material modification requirement that amends your summary plan description. And although the technical legal deadline may be a few years for that, what we would recommend is that the distribution of some sort of document which will act as an SMM, telling participants about the changes made to the plan. And so I expect that'll happen probably at the beginning of next year with respect to 2023 provisions, after we know who's all adopted these provisions. So that's kind of a timeline where we've got going the next couple of years. Again, we've only touched on some of these Secure 2.0 provisions. We're going to do another full hour, I anticipate, next Wednesday, same time, 10 a.m. To go through the rest of the Secure 2.0 provisions. So with that, that's all I had with my prepared remarks. I'll be glad to take any questions at this time. Alternatively, again, if you're more comfortable doing so, feel free to contact me after the presentation, either by phone or by email. And my contact information is right there on the last slide.
So before we get to questions, first of all, thank you, John. Appreciate it so much. We're going to get to the chat box here in a second. I'm going to pause the recording and then we'll get to questions. We'll let John catch his breath a little bit. Great information, John. Thank you so much. And thank you all for joining. Give me 1 second here. I'm going to pause the recording and we'll get to questions.